don't fall for the suckers rally. Over the past couple of weeks, we've seen some pain in markets, and we've seen investor sentiment move from extreme greed to extreme fear. This has been driven by long-term interest rates surging to multi-decade highs. And it's very likely we are in for a relief rally, which is going to suck a lot of bulls into buying, despite the fact it's a suckers rally. Don't fall for it, because there is one major underlying fundamental reason driving everything economically speaking right now. And I'm going to show you how that one fundamental driver is infiltrating its way through inflation, the Federal Reserve's interest rates and inflation fight, the bear market in US Treasuries, and ultimately a coming meltdown in the stock market. If you don't know who I am, my name is Joe Brown. I run Heresy Financial Universities, where active investors learn how to make more and lose less by learning how markets actually work. And just a heads up, if you're waiting for a reason to join, this is your sign, because right now I am running a discount that gives you your first month for just $1. Use coupon code HERETIC99, and legitimately there are only 99 of these coupon codes available, which means that once this code has been used 99 times, it will no longer work. So if you're interested in getting your first month free, use coupon code HERETIC99, click on the link in the description below, and don't wait, because these things are gonna go fast. It will not work after the first 99. Okay, so what is this one unstoppable fundamental driver that is moving everything forward, or maybe everything backwards in the economy right now? Well, that unstoppable force is the federal government's unstoppable deficit. Now, you might be thinking we've had a deficit for forever. We've literally only run a surplus for a few years in our entire country's history. What's different about it this time? Well, let me show you. The current national debt is $33,146 billion. But that's not exactly true. You see, this is just the amount the federal government has borrowed, which is different than what they owe. You see, the US debt ceiling statute caps the face amount of the US debt. And it means that the debt is always stated in the face value of the debt, meaning that's the amount that they borrowed, not the amount that they owe back. Now, if interest rates were 0%, then this would be the exact same amount. But we know interest rates are not at 0% and they're moving higher quickly. So what is the true debt right now? And this isn't even counting things like unfunded liabilities. Well, in recent quarters, we've seen an absolutely historic spike in interest payments on the debt, currently at just under $1 trillion. Doing some quick math, we can see that this represents about 2.9% average interest rate on the national debt pile right now. Just take 969 billion divided by the national debt of 33 trillion. But we also know that interest rates have been surging recently. We also know that half of the national debt is maturing within the next year and a half, which means it's going to have to get paid back with borrowing new debt. Half the national debt right now is roughly $16 trillion. And at current interest rates of right around 5%, that would mean that just in the next year and a half the national debt's interest payments will equal $800 billion. If you add $450 billion, which is the interest payments on the remaining half of the national debt, then in a year and a half to 2 years, the federal government is going to be paying $1.25 trillion just in interest payments alone. And that's assuming there's no additional buildup in debt from additional deficit spending, from additional borrowing, from additional spending on anything else. That's just the result of the interest rate situation alone. So we know this is the base case scenario, and it'll likely be much worse. The market's starting to realize this runaway train is what is driving interest rates, especially at the long end of the curve, much higher right now, especially because it seems as if the Federal Reserve is slowing down or even stopping its fight against inflation. They're holding short-term rates, but inflation is not coming meaningfully down below 3%. And if other factors like deglobalization and increased energy costs and the deficit cause inflation to pick back up again, well, then long-term rates have to rise to compensate lenders for that increased loss of purchasing power. But first, a word from today's sponsor, I Trust Capital. Investors today face all sorts of new and unique risks. Invest in stocks and risk a stock market crash. Invest in bonds and watch the value of those bonds drop as interest rates rise. Keep your money in cash and watch inflation eat away your purchasing power. Invest in crypto and watch frauds like Sam Bankman-Fried steal all your money. This has many investors looking to alternative stores of value like gold and Bitcoin. The problem with this is that most investors investors are not able to access gold and Bitcoin. This is because most people have most of their assets tied up in their retirement accounts. And most retirement accounts do not allow you access to things like gold or silver or Bitcoin. This is where I Trust Capital comes in. I Trust Capital allows you to open up a new retirement account or even transfer an existing retirement account. Then you can purchase alternative stores of value with your retirement like gold, silver, and Bitcoin. In days like this where fraudulent platforms like FTX are collapsing and traditional banks like Silicon Valley Bank are failing from bank runs, I Trust Capital is still going strong because they do things the right way. You own your assets there. Your assets are always held off balance sheet and your accounts are never commingled with theirs. They partner with industry leaders like Kitco for their precious metals. They're straightforward about how they keep your assets separate and safe. And if you use my link in the description below, you will get $100 worth of Bitcoin just for signing up. Now, this historic rise in interest rates on government debt is negative for asset valuations for two reasons. Number one, crowding out. Right now, the dividend yield on SPY, which is an ETF that invests in the S&P 500, is 1.5%. Now, that used to be much higher than US Treasuries. So you can invest in the 30-year, the 20-year, the 10-year, the 2-year, the 1-year, or anything shorter than that and get 3 to 4 times that income. So imagine with me for a second, hypothetical scenario, interest rates on US Treasuries are 10%, 15%, 20%, guaranteed by the full faith and credit of a government with a monopoly on violence. By any investor's calculation, you would be a fool to invest in stocks instead of treasuries, especially with the PE ratio of the S&P 500 at multi-century highs, excluding a few of those recent peaks from recent bubbles, which means that any rational investor would not touch stocks with a 10-foot pole unless the valuations came down to a reasonable level. And you always have to take the risk-free rate into account when looking at valuations of equities. Now, if you've been watching the channel for any length of time, you know that I've been telling people to stay away from bonds, especially long-term bonds, for a long time now. My tune on that has never changed. And anybody who paid attention to those warnings has avoided the suffering of anybody investing in something like TLT, which is supposed to be a safe haven asset, because this is a fund that invests in US Treasuries, which means that since interest rates have been rising, it is now down over 50% from its peak. Yet because of the uncertainty, especially in the equities markets, there are still a bunch of people buying things like TLT. In fact, TLT has seen roughly $15.6 billion in inflows this year. 15 billion of dumb money. Stay away. Again, the main driver of all of this is the unstoppable deficit that can't slow down. The government has way larger of an appetite for borrowing than the economy has money to lend it, which means rates will have to continue moving higher. The inverted yield curve will uninvert, long-term rates will continue to jack sky high. And yes, some big money is buying treasuries like hedge funds, but this is for the basis trade. The basis trade is an arbitrage trade. It's a relative value trade that allows hedge funds to take advantage of the different rates that are available to big money. And on one side of the trade is treasuries. Anytime you hear the word relative value, that should make you turn and run because it has triggered more financial crises in the last 20 years than anything. Now, it's true, we are in for a relief rally here. Taking a look at a few technical indicators, we've seen this trend line hold steady for almost a year now. Additionally, this most recent bounce at the end of September happened right as the relative strength index hit oversold territory, which means that we are likely due for a bounce here, especially considering that investor sentiment has now reached extreme fear. This is usually somewhat of a contrarian indicator, and when you see multiple technical indicators like trend lines and relative strength index, and then things like the fear and greed index showing that investors are now fearful, we're likely to have a relief rally. But this is a sucker's rally. The economic carnage, especially in the stock market, is just beginning. We're at the top of a bear market here. Yeah, a bunch of investors are going to be fooled. They're going to think the selling is over and they're going to pile back in right at the wrong time. So don't fall for it. And I'm definitely not saying go all to cash. Time is the #1 ally for investors. You never want to interrupt compounding interest. So stay long, but hedge. Bet on the downside. Now, at this point, if you don't know how to profit off of both a bull market and a bear market, I'm going to describe what you've probably done for the last last 3 years. You've probably flip-flopped between major positions. You've bought in at the tail end of every major rally in every major asset class. As soon as you buy, the rally is over and you've lost money every time. You move on to the next, repeating the same mistake over and over and over again. Now you're realizing none of that works, but you're about to make the exact same mistake you've made over and over again, because you're about to commit to long-term passive investing in the traditional 60-40 portfolio, not realizing you're doing the exact same thing you've done before, buying in at the tail end right before a major collapse. Don't do it. You need to learn how to make money in both bull markets and profit in bear markets. And if you don't know how, I'll teach you how to do exactly that, how to make tens to even hundreds of thousands of dollars more than what you're doing right now for just $99 a month. And if you use code HERETIC99, which there are literally only 99 of, if you're not one of the first 99 to use it, it's gone, it's done. But if you're one of the first to use that code and you get in before it is used up, then you get your first month for literally $1. The longer you wait, the more you miss out on opportunities to make money in every market. So sign up with the link in the description below. As always, thank you so much for watching. Have a great day.